Hi, my name is Jim, and I was retired. Welcome back to part 4 of this tour of a do-it-yourself spreadsheet that I use to plan withdrawals in my forced early retirement. Somebody once said, the hardest thing in the world is to understand the income tax. Well, stay tuned to this video, and I'll show you how I handle the income tax in my spreadsheet. And I'll also let you know who said that and where I found it on the internet. So stay tuned for my DIY Retirement Withdrawal Strategy Part 4. The last 3 videos have gone through various parts of my do-it-yourself Retirement Withdrawal Strategy spreadsheet. In Part 1, I introduced the input screen where you put in your basic assumptions. And in Part 2, I showed you how I designed the main sheet or base case for the retirement withdrawal strategy. And Part 3, I showed you some of the formulas that I use to calculate the withdrawals and earnings. And I showed you a glimpse of how I do income tax. Well, this video is all going to be a closer look at how I calculate taxable income and future tax payments into my retirement. Before I do, I should give you my standard word of caution. I am not a tax accountant. I am not a financial planner. I have no special initials after my name. So take this as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need it. And be sure to like and subscribe to the channel. The more likes I get, the higher it'll be in the search results. So let's just review all of the columns starting here in age 60. And you can follow along down here where the formulas are, but I'll explain them as I go. The balances in all the subsequent years after the quicken value is to take the prior year's balance, add the withdrawals or deposits, and then add the earnings. Those 3 figures add up to this number. And that's how you get all of these numbers. You just pull that down straight and it does it all. And that's true for all of these balance categories. The total retirement assets here is simply a sum of all of those numbers. As I explained before, I had zeros in these fixed income sources. I'll jump down real quick to show you what happens when you reach an age where you will start a pension. And so this looks at the calculation and says, is your age here in C10 less than the input age, which was the age where you said pension was going to start? If it is, it's going to put a 0. And then it's going to say, if not, it's going to do this if statement. If the age is equal to that age on the input screen, you're going to use the input screen's amount of pension for the first year. And if that's not true, then you're going to take the prior year's pension amount and times it by an inflation factor. In this case, the inflation factor is close to the Social Security COLA, which is a 10-year average 1.5%. And I'm using that for both the pension and Social Securities. So over here in the withdrawal categories, this is the formula we showed in the last video. It basically is a statement, an if statement that says if you're less than 72, to calculate a withdrawal based on the payment formula. If you're 72 or older, use the RMD, required minimum distribution factors, from the RMD table. The total withdrawals is the sum of that. The withdrawal rate is that divided by the total retirement assets to give you the withdrawal rate. And then the earnings I showed last time as well. They are your prior balance plus any withdrawals or deposits, and it is a plus even though it's a minus for a withdrawal, but plus any withdrawals or deposits times then we're using the real rate of return off the input screen. And that's true of all the earnings. That adds up to, this calculation shows the sum total earnings. And then here in total available income, as we discussed in the last video, it's your fixed income sources plus the withdrawals from the retirement accounts that you've chosen to make. Then in expenses, it starts with a figure from the input screen in the first year, but then that goes up by an inflation rate with that formula down here of that prior figure times 1 plus then the inflation amount. This is a simple sum of those expenses and available income to say what the shortfall or surplus is. And then we'll go through these in greater detail, the taxable income, the tax rate, and estimated taxes. And I'm going to show that up here in 59, age 59 again. So let me go back up here. Taxable income is going to be your pension plus 85% of your Social Security amounts, both the primary Social Security and the spousal benefits. So those are added, plus you're going to add the earnings for the brokerage and savings accounts, and then you're going to add your withdrawals. That adds up to your taxable income. Now, this formula for estimated tax rate is going to use that figure. It's going to look up that figure, and here I'm going to go to edit the formula so you can follow along with the formula. It's going to, with a VLOOKUP, look up that formula, and it's going to subtract a standard deduction. And let me show you that. I'll jump over here to the table. And then it's going to then look that number up in this table here and use the fourth column to come back with a tax rate. So let me say no to this to go back. And in this case, it turns out to be a 14.45% for the tax rate. Now let me go back to the taxes sheet to show you what I've done here. This is oversimplifying the income tax system we have in the United States by far. But I've done this, and you'll want to do it in your own circumstances based on what state you live in. But what I've done is I've taken the married filing jointly tax brackets, and I put next to them the New Jersey tax brackets, and that gave me a combined tax rate. And that's the number I'm using. And it is definitely a ballpark oversimplification of our tax code. Then this calculation here of estimated taxes is, again, I'm using that taxable income minus the standard deduction times that tax rate. Now I've chosen to do the standard deduction in the formulas here for the tax rate and the estimated taxes because I want the taxable income to kind of represent an adjusted gross income. Then I've added the taxes and the expenses together, and that gives you, again, you're going to take a surplus or shortfall from your available income and this, and you can see this is pretty darn near zero, and why that's the case is I've adjusted all of the withdrawals from brokerage and savings to come out close to zero, and I'm doing that rather than relying on an arbitrary 4% withdrawal rate. As you can tell with Social Security and pension not starting, a 4% withdrawal rate would leave me well short of what I need to meet expenses. And the tax rate eventually will go up too. And here at age 70, when Social Security comes into play, the taxable rate here in this formula goes up from 14.45% to 25.5%. And that's really a reflection of the federal tax rate going from 12 to 22%. So that jumps up and continues for the rest of retirement in this scenario. When you come down here and look at the estimated taxes, I've also got a figure down here that says that over this full retirement, and these are retirees that live into their 90s, they'll be paying $904,000 in taxes in their retirement. Is there anything we can do to reduce that number? Well, that's the whole purpose of this retirement withdrawal strategy worksheet, is to give you a playground to explore ways that you might reduce that overall tax hit in retirement. Oh, before I go any further, so who said the hardest thing in the world to understand is the income tax? Albert Einstein. What's even more surprising is where I found that quote, along with a few other choice quotes about taxation, on the IRS.gov website. So is there anything you can do to reduce those taxes over your retirement? Well, one simple strategy might be to get rid of those required minimum distributions that push you up into higher and higher tax brackets later in your retirement. Let's look at one simple scenario. It's a very simplistic scenario, but I want to give you an example on how this spreadsheet can be used. And to do it, I'm going to walk you through the changes. So the first thing we're going to do is duplicate this sheet. I've gone over here and I've created a new sheet, duplicating the main sheet, and I've renamed it On Screen Eliminating RMDs by 72. So rather than payment for these calculations, we're going to simply divide by 13 in these first years and then 12 in the next and go on down to eliminate RMDs by the time you're 72. The magic of quick cut and paste is going to do that for us. Copy this. And I'm going to paste formula results. And boom, those RMDs are gone. And those RMDs are gone. And those RMDs are gone. Now, what does that do to the surpluses and tax situation? Well, you come out here and you'll see there's a lot of surpluses here and shortfalls in the later years. After you eliminate the RMDs, you need to come over here and change all of these to 0 for now. Now, when you come out here, you're going to see some shortfalls and surpluses. And I'm going to copy these here. So I'm going to copy all of those shortfalls and I'm going to paste them into the broker withdrawals. And I'm pasting formula results. And that'll get closer to break even every year. But it's also going to wipe out your brokerage balance at some point down here at age 92. And so coming over to age, say, 90, just for cushion, 0. Now you come back over here and you see, again, this isn't perfect. You've got $10,000 more too much here, and then you got some shortfalls here. Eventually, you'll need more money here starting at 90. So I'm just going to copy these, paste the formula results here, and I know the last few are going to be still missing. And so again, you take these, maybe copy and withdraw them from savings and paste these formula results here. And through trial and error, you bring this back into alignment through deductions, changing the amounts of your withdrawals from your accounts until you break even here. All right, I'm going to continue a little bit to see if I can show you a high level view of how this might work once you've balanced all those out. So in eliminating RMDs, you can see I've got them pretty much balanced out. However, when you get that precise with eliminating RMDs by age 72, you can actually spend more than you intended. Now look, with strategic Roth conversions, staying within your tax brackets as much as possible for as long as possible, you can reduce your taxes substantially. This sheet totals up $674,000 in taxes. And I created a system over here that shows you how those three scenarios of taking RMDs when they're required, but only when they're required, and eliminating RMDs by the age of 72, or strategic Roth conversions. And I've created this tax chart here, which grabs the taxes from the columns on those sheets for the main sheet, the one without any RMDs, and the one with Roth conversions, strategic Roth conversions. And I've created a system that adds them up for the total running balance and then creates this chart that allows you to look at how the taxes are paid over your retirement and what line do you want to follow in your retirement. That's a broad overview of this spreadsheet that I've designed to manage my retirement withdrawal strategy. In the comments below, how do you manage your retirement withdrawals? Do you use a 4% or a different number? Do you use something like this that's strategic? Are you using a variable based on how market performs? Let me know in the comments below. Now, I do topics like this on how to manage a forced early retirement. That's why I call it I Was Retired. And if this topic appeals to you, please be sure to like and subscribe to this channel. The more thumbs up and subscriptions, the more it'll come up in the search results. Now, I would need 1,000 subscribers and 4,000 hours to get any money out of this. I'm not doing this for any money that YouTube might give me. I'm doing this to share what I've learned in the last 5 years of my forced early retirement, and I hope it helps. See you next time.